What a credit score is. At its most basic level, a credit score is a prediction. It's not a grade. It's not a measure of responsibility or character. It's not a reflection of your worth as a person. A credit score is a number created to answer one narrow question. How likely is the person to repay borrowed money on time? That's all the system is designed to estimate. To do that, credit scoring companies look at patterns, not intentions, effort, or circumstances. They don't know why something happened. They only see whether certain events occurred. Your score exists to help lenders make decisions quickly, using standardized data rather than personal judgment. Where credit scores come from. In the United States, credit information is collected by three main bureaus: Equifax, Experian, TransUnion. These bureaus gather data from lenders, banks, and service providers. The data includes things like when an account was opened, the balance reported each month, whether payments were made on time, whether an account was closed or sent to collections. Using that information, scoring models generate a number. The most commonly referenced models are FICO and VantageScore. That's why you may see slightly different scores in different places. They're using the same data, but applying different formulas. How credit scores are calculated. While scoring models vary slightly, most use the same 5 categories. Understanding these categories makes scores much less mysterious. Category 1. Payment history. This is the largest factor. It reflects whether payments were made on time, late, or not at all. The system does not evaluate the reason behind a missed payment, only that it happened and how late it was. A payment that's 1 day late usually is not reported. A payment that's 30 days late often is. From the system's perspective, consistency matters more than context. Number 2, credit utilization. This refers to how much your available credit is currently being used. For example, if a credit card has a $1,000 limit and the balance reported is $300, the utilization on that card is 30%. Lower utilization generally signals lower risk because it suggests the person isn't relying heavily on borrowed money. This is one reason scores can fluctuate month to month, even when nothing feels different in real life. Number 3, length of credit history. This category looks at how long accounts have existed. Older accounts provide more data, which makes prediction easier for the system. That's why long-standing accounts often help stability, not because they're better accounts, but because they provide a longer pattern. Number 4, credit mix. This simply reflects the types of accounts reported. Credit card, auto loans, student loans, and mortgages all appear differently in the data. The system isn't looking for perfection here, only variety. This factor is relatively small compared to payment history and utilization. 5, new credit activity. When accounts are opened or applications occur, the system temporarily assumes increased risk. This effect is usually short-lived and fades as the account becomes more established. Why credit scores change so often. One of the most frustrating parts of credit scores is how frequently they move. A score can change because a balance was reported on a different day, a payment posted slightly earlier or later, a card was used more than usual 1 month, a lender updated information. These changes don't necessarily indicate problems. They reflect timing, not behavior. Credit scores are snapshots, not permanent records. Common misunderstandings. There are several widespread beliefs about credit scores that create unnecessary anxiety. Let's clear up a few of them. Checking my score lowers it. This is one of the most frequent concerns. When you check your own credit score through a bank, credit card app, or monitoring service, it is recorded as a soft inquiry. Soft inquiries are visible only to you and have no impact on your score. The type of inquiry that can affect a score is called a hard inquiry. Hard inquiries occur when a lender reviews your credit as part of a formal application. Even then, their impact is usually small and temporary. The important distinction is that viewing your own information does not count as borrowing activity. The system treats self-checking as neutral. Carrying a balance helps my credit score. This belief is extremely common. Many people are told that leaving a small balance on a credit card demonstrates responsible usage. In reality, credit scoring models do not evaluate interest payments or whether debt is carried forward. They do not measure profitability for lenders. What they record is the balance that appears on a statement and how that balance compares to the card's total credit limit. This measurement, known as utilization, is based on reported numbers, not intent. Whether a balance is later paid in full or carried into the next month does not change how the balance itself is interpreted. From the system's perspective, only the snapshot at the time of reporting exists. Closing cards always improves credit. Closing an account can feel like a positive step, especially when simplifying finances. But within the credit scoring system, closing a card changes two pieces of data. First, it may reduce the total amount of available credit, which can affect utilization ratios. Second, over time, it can shorten the average age of accounts, as older accounts eventually fall off a report. This doesn't mean closing a card is inherently negative, only that the effect depends on the overall profile. The system does not interpret closures emotionally or morally. It simply recalculates based on the remaining data. A single mistake ruins everything. This belief often causes the most stress. Credit scoring models are designed to identify patterns, not to permanently label individual events. While missed payments or collections are visible, their influences changes over time as new information is added. As months pass, recent behavior naturally carries more weight than older entries. This is why scores often stabilize gradually, even after setbacks. The system is continuously updating, not issuing permanent judgments. Why these misunderstandings persist. Many credit rules feel inconsistent because the system itself is not intuitive. It was built for statistical prediction, not human understanding. Once the difference is recognized, much of the confusion begins to soften. Why credit scores feel so personal. Credit scores often feel emotional because they intersect with real life. They affect housing, transportation, and opportunity. But the system itself is not emotional. It does not know effort, hardship, or intent. It only recognizes reoccurring data points. Understanding that separation between persona and the system can reduce a great deal of stress. A credit score is not a story about who you are. It is a statistical summary of how certain accounts have behaved. A calm takeaway. Credit scores are not rewards or punishments. They are tools built to measure risk using limited information. They fluctuate because life fluctuates. They simplify because systems must. Understanding how they work doesn't require urgency or fear. It simply provides context. And when systems feel more understandable, they often feel less heavy. This explanation isn't meant to answer every question, only to make the system itself clearer and easier to understand. Many parts of modern life function in similar ways. They aren't explained very often, yet they influence our lives far more than we realize. This video is simply the beginning, a way of making those systems a little more understandable with time and clarity. In future episodes of Quietly Explained, we'll continue taking space to understand the systems that quietly shape our everyday life.